Thanks, Joe, and welcome, everybody. My name is Paul Zahara, and my background is as a financier, primarily as a tax-based financier in the early days, and then in later years I went on to asset-based finance. The importance of that is that if you're going to be involved in tax-based finance, then you have to understand how the tax works, and you have to find out how you can manipulate the tax in such a way as to optimize the output. So the first question that we're looking at is, why do we have taxes? And I think the important point here is that taxes are designed to operate a society, not only an economic mechanism, but there's a mechanism to help us fund the resources that we need for a society. Unfortunately, too much of the tax debate is conducted in a fact-free zone. So I want to just start with a few facts. The Australian tax revenue comes from a number of different sources. The red bit here is personal income tax, and that accounts for about half of all of the tax revenue that the government gets. The blue bit is corporate tax. So that's roughly a fifth, about 20%. GST is about a third, a little bit less. And then withholding tax, which gets paid for overseas companies, is only about 2%. So how does that compare to other advanced economies? Well, if we look at the US, their income tax is roughly comparable to ours, a bit less, but in the same order. Corporate tax, the blue bit, is considerably less. Now, I think this is one of the sources of a lot of the urban myths, because Australia and the United States are obviously quite different in this regard. There's not nearly as much corporate tax as a total of the total tax take that comes from companies in the US as it does in Australia. Sales taxes, roughly similar to ours. The employer social security contributions is pulled out as a specific line item, which is basically a cost of employment. And then finally, fuel taxes up at the top. Looking at corporate tax rates, well, where do we fit? Quite often we hear about Australia being a high tax country. The United States is roughly around 40% as a corporate tax rate. Australia, around 30%. Canada, I like to use as a comparable because it's an advanced country that also has a resource-based economy. And once you get past about 25%, that's where the vast bulk of the countries are. Now, yeah, thanks, Joe.
And just while Paul gets his microphone in order, Australia has an enterprise tax plan. The Liberal Party has announced that they would like to reduce our corporate tax rate to 25% over the next 10 or 12 years. It's been blocked in the Senate. It's unlikely. They'll keep putting it back, we understand, to the Senate, but currently it's stuck. So currently we're stuck with the original plan, which effectively will result in a 25% corporate tax rate for corporates with turnover up to $50 million, but that's going to take about 10 years to be phased in.
And I should have introduced Matt Shanahan earlier in the piece. Sorry about that, Matt. Matt Shanahan is a tax partner at Deloitte. Matt's not only an accountant, he's a lawyer, so he has an excellent understanding about tax law, and he advises some of the largest companies, not only in Australia, but around the world. My look at this is from a bigger picture. Matt is a guy who's right down in the trenches, and he'll correct all the mistakes I make on the details. One of the important ways to understand how tax works in an economy is not only to look at the nominal tax rates, but to have a look and see how much of the total economy is absorbed into the government sector. So government revenue as a share of GDP is an economic indicator that we use quite a bit to compare different countries. So at the bottom, on the red is China, the green is Australia, the blue is the US, the gold is Japan, the dotted line is Canada, and the solid line is the Eurozone. So you can see that Australia, as the green, is down towards the bottom. So government revenue as a share of GDP is right around 24-25% now. And most other advanced economies are considerably more than us. And interestingly enough, China is now starting to report their tax on a more or less similar basis to us. And they're roughly in the same avenue as we are. Looking at revenue as a proportion of the total economy, now let's compare that to how much debt does a government have? Because if the government isn't collecting enough revenue to fund its activities, then the only other place for money to come from is for the government to create debt. And using the same colors, China on the bottom with red, Australia green, the Eurozone is blue, Canada is the dotted black one, US is this blue one, and then Japan is up here. Now, most of you will remember Paul Keating's famous talk about banana republics. Now that was done back here. Remembering Australia's a green, guys. We're back in the 90s. Our debt got up to about 40% of GDP. So what that means is that over the course of a year, about 40% of all of the goods and services that everybody in the whole country works for would be ticked up on our national credit card. Over the course of the 90s, that came down to around 20%. And then all of a sudden, when we got to the GFC, unfortunately, we undid all of the good work that we've taken 10 years to grind our way through to get back to. Even so, at 40% of GDP, we're one of the lower debt advanced economies around the place. The United States is in a lot more trouble than we are, in that they've got roughly 3 times as much debt. And poor old Japan is in really, really bad trouble. If Japan wasn't such a strong export-oriented country, and if almost all of this debt wasn't held by Japanese people, they'd be having a really serious Banana Republic speech going on there now. But as it stands, they're still going to have to do something serious to attack that problem. Okay, I'm going to let Matt explain this one.
Come on, Mike. The reason I'm explaining this actually comes from our economics house at Deloitte Access Economics. One thing I wanted to say initially is that the views I expressed tonight are my own. They're not my firm's views. So don't be mistaken that my firm's views. These are my independent views. What this slide is demonstrating is the so-called bracket creep in Australia. So what we've done is forecast out. So if you looked at the dotted green line in the middle, what that is demonstrating if you're at the average wage in Australia, what will happen to your tax rate over time if we were to do nothing to the brackets that we currently have. So they're so-called bracket creeps. So you'd end up with an increase of 5% in the amount of tax you would pay if you're an average taxpayer. The light green dotted line is if you're half the average. And so basically what we're trying to just demonstrate here is the effect of bracket creep. Whereas you can see at the top end, in terms of income, because I don't actually go through the brackets, they're already through the brackets, they don't actually have the same quantum of increase of tax over time. So I'll hand back to Paul.
Okay, so having looked at some of the furphies or urban myths about tax, number one, Australia is not a super high tax economy. We're reasonably good, actually. We're towards the bottom. And we're not going to die of debt overdose in the next year or two, but it's certainly something that we shouldn't take our eye off of. Let's take a look now at some of the concepts that get this thrown around in the tax discussions. There's tax evasion, which is illegal. And like any other law that the government has, if you don't follow the law, there's sanctions and penalties and that kind of stuff. So if you want to be really dumb and attract the attention of the tax office, there's lots of things that you can do to get in trouble. Things like underreporting income. So that's the old, the price is $200 if I have to give you a receipt, but it's only $150 if it's cash in my pocket. 2 sets of books, that's obviously not kosher. False claims for deductions. People claiming for deductions for things like their clothes and their house and all the rest of that. Hiding assets or hiding income. Hiding assets sometimes happens by going overseas. Hiding income often happens by paying your wife, your kids, your dog, whoever a salary. And sham transactions. One of the classics is to make a loan to a shareholder, and then that kind of helps to make income disappear. Those were kind of dumb and simple strategies. Here's some more complicated strategies. It tends to get used a little bit more by corporations rather than by individuals. Thinly capitalized companies. This is a classic. It's been around for a very long time, and it's used by multinational companies, where the local subsidiary basically looks like it's a poverty-stricken company ready to fall over and die. But the reason for that is that all of the profits are being sucked out through various charges or accounting entries to move profits out of a high tax regime to someplace else where there's a lower tax regime.
Can I step in there? So the thin capitalisation rules are quite complex. So currently there are 3 tests that are in the legislation if you don't have an exemption. There's a safe harbour, which is effectively a 60% debt to asset ratio, debt to assets ratio. There's an arm's length debt test, which in effect is on the basis of particular assumptions, how much would a third party lender lend you, and then you can have that level of debt. And then there's a worldwide gearing amount. And what the worldwide gearing amount is effectively look at your corporate group globally, how much do they gear? And you can gear in Australia to the same extent. Interestingly, the 60% safe harbour is regarded as being very generous. It's been reduced from 75% a few years ago, so it's even more generous at that point. But reducing it to 60% is still generous when there's certain studies that have shown that the major listed corporations around the world on average have about 30% debt. And so at 60% it's actually quite high. And the Labor Party has announced their policy will be to go to a worldwide gearing test. And particularly for some of I'll go into a case later on in relation to a mining and exploration company. Apparently their average debt is about 10%. So, but they're actually getting to gear at 60. So you can understand how these rules are in place. People are complying with the law, but sometimes the law might have to be reassessed.
Profit recharacterization. This is kind of an interpretation. So that when income comes in, how do you allocate it? And all accounting involves a degree of judgment on behalf of the people who are doing the accounting entries. And sometimes it happens that people will characterize income in a way that's a little bit more favorable for themselves. Tax havens. Now, we've seen a lot of publicity about this recently, and there are some tax havens left, but over the past 10 years or so, there's been a lot of work done on international cooperation to try and eliminate tax havens as much as possible. There's a number of low or no tax jurisdictions that don't cooperate with Australian tax authorities anymore, but there's only a very few of them. There used to be maybe a couple of dozen tax havens around the world. Matt, how many would you say are left?
Well, the ones we commonly use, they're still around. I suppose what's occurred is that they still might be low tax jurisdictions, but the question is the domestic laws, particularly in Australia, have been amended in a way that can make it less attractive to actually use those places as destinations. I'll actually get on to an example of a law that has been instituted, it's current, it's applying, that actually is being put in place in order to minimise the use of tax havens in relation to particular business outcomes. But yeah, I can't know off the top of my head, but you know, the Cayman Islands, these places, the Isle of Man, there's Panama, well, there's a lot of different jurisdictions around, but the question is whether it's feasible to even use them anymore. And Paul's already alluded to the fact that there's an OECD initiative that's ongoing called the Base Erosion and Profit Shifting Regime, and Australia has announced that they will support it, they will legislate and they will implement the BEPS regime in Australia. And the profit recharacterisation point from earlier on, it also goes on to talk about things like hybrids. And Australia has announced that they will be implementing the hybrid laws, the hybrid paper, and I'll talk a bit more about that a bit later. But in essence, it's there's a mischaracterisation between jurisdictions.
Okay, and the final one here is particularly egregious because not only is it used to dud the taxman, it's in many cases used to dud small creditors. So you'll see lots of small businesses will take a company right to the point where it collapses and they won't pay their bills to their suppliers, they won't pay their bills to their employees, they won't pay their tax bill, the company will go into bankruptcy, and the directors will start again with a new company 2 weeks later in the same business doing the same thing over and over again. Okay, so all of those things that we've spoken about to this point are illegal. Now let's look at tax minimization. This is legal. So what we're talking about now is ways that people can use existing laws to minimize their tax bill. Now, this is kind of like going to Aldi rather than going to Kohl's to buy your groceries. You don't voluntarily pay more than you need to pay. So optimizing use of deductions is a technique where you take the deductions from a company that can't use them and you pass them to a company that can use them. Back in the 80s, I worked for a company who did tax-based finance, and we were involved in a lot of leveraged leases and cross-border leases. What happened in those days was that we were able to take the depreciation benefits. So if you own something like an airplane, and you're entitled to write that airplane off over a period of, say, 5 years, which is what it used to be a long time ago, that gave you a deferral or an advantage for your tax position. Now, if your company wasn't making profits, that benefit was of no good to you. It just didn't make any difference. So what would happen was that those tax benefits would be passed to another company that could use those tax benefits. And the company that was using the airplane got the benefit through the use of lowered financing costs. Now, this was kind of a win-win for everybody on the basis that the government had put in those tax benefits for owning that airplane, and those things were costed into the budget. So the economy had already taken account of the fact that somebody was going to use them. If the operating company that was going to use the airplane didn't have those tax benefits, the financing costs meant, in many cases, that it was too expensive for them to buy new airplanes. So we got stuck with old rubbishy airplanes. So what happened here was basically the use of economic efficiency, where something that was already costed into the economy was passed from a place where it couldn't be used to a place where it could be used. The next strategy is tax structuring. So this is conducting business in an entity with a lower tax rate. Now, the entities that we have are companies, trusts, individuals, partnerships, a few others on the margin. One of the big problems is if you have differential tax rates between those different entities. So one of the simple ways to fix this is to make sure that the top marginal tax rate for individuals is the same as a corporate tax rate, the same as the same tax rate that is paid by trusts, and so on. So what that means is that there's no real advantage to shifting your business from one entity to another for tax purposes. And finally, structured investing. This is kind of a corollary of the first one, where people who had tax bills could invest in assets that had depreciation benefits or other permanent benefits, and they would get an increased return on their investment. Now, that meant that there was more investment in the economy, and that meant that this optimized use of the deductions was something that was able to be utilized within the economy.
Thanks. Now my part of the presentation. Thought I'd start off by each year, like one of the things that the Australian government is very focused on is disclosure. And so over the last couple of years, they've released statistics in relation to who are the top taxpayers in Australia. And they list everybody. And so there was a lot of lobbying around this, particularly from the private investors saying that there's potential for kidnapping and all sorts of things. So there's actually two levels. There's two levels. So anybody who's got over $100 million of income, they are reported. All the corporates with over $100 million of income in a year will be reported. They'll disclose these statistics in relation to those taxpayers. And for private enterprise, for private groups, it's 200 million. So there's a separate threshold, but still, if you're 200 million or over, you will have these statistics disclosed about you. What's quite interesting is actually, look, I actually had 20 before, but it was actually quite hard to read. So I've just put 10 now. But you can sort of see the sort of flow of where most of the tax revenue comes from. You've got the big four banks, you have the two miners, you have Telstra, and you've got Wesfarmers Woolworths, our two big retailers. Interestingly, you've got a company like Shell, and so they are an international investor. And if you go down into the next 10, there's actually quite a few other international investors, particularly out of Japan. Each year, my firm hosts a symposium for the top heads of tax in the country. And this year was quite interesting because one of the heads of tax sort of spiked up, because at our symposium we had Treasury, and we had some of the people who are responsible for the bank levy. And all the talk has been around paying your fair share. Pay your fair share of tax. And so what was interesting is we've come out with a bank levy. So we're going to raise apparently an additional $6.2 billion of revenue over the next, I think it's 3 years, basically by hitting the banks. And we've just extracted again where these banks are paying. They're basically paying 30% tax on their profit, and they are being required to pay additional tax. So it's a big question, and this is one of the things that's raised by that head of tax to say, are we being hit unnecessarily? because we are paying our fair share. We are paying the 30% that you want us to pay, and now you're asking us to pay more. This is another interesting slide. So each year the Treasury comes out with their top tax expenditures. And it's quite hard to read, so I'll read some of it out to you. But these are not only expenditures as in the government forking out money, for example, for health, for welfare. These are some of the really big expenditures. These are the things where the government's actually foregoing revenue. And it's really quite an interesting graph because you start up right at the top, there are some business incentives. You can see it's relatively small. But by the time you get down here to the bottom, the majority of the concessions that are giving rise to tax expenditures relate to things such as the capital gains tax discount, the superannuation contribution concessions, the concessional tax rates on super funds, the main resident CGT exemption. So it's really quite interesting that if you actually start adding these up, like particularly the main resident CGT exemption, when you actually incorporate the two, it is a huge number. We're talking probably about $60 billion a year, that we've got huge expenditures here. And so you can sort of understand that we also need to have regard to what we're foregoing, not only what we are collecting. I'm going to take you through a few different things that people do, I think particularly the topical ones, but I think a theme that needs to come out here is that we have an extremely aggressive tax authority. We have a legislature who are trying to clamp down. It seems to be political, that you want to be the person who gets the most tax revenue, introduces a lot of things like, I'll get onto it a bit later, but late lodgement penalties. It became an auction in relation to how much people were going to be charged if they lodged their tax returns or a BAS or any tax obligation late. It's now $105,000 if you lodge 1 day late if you're a significant global entity, which is an entity with an income globally of $1 billion or more. $105,000 potentially. So one of the things that's been quite topical, particularly with respect to the Labor Party, and the other day the announcements of Bill Shorten, related to family trusts. So I'm not sure how many people in the audience actually are aware of what the family trust and what the concern is. But in essence, what it is what Paul was talking about before. It's the differences in tax rate. And so if you're a salary and wage earner, basically you pay tax on the amount you earn. You can't alienate the income. It's non-alienable. You can't actually move it. Whereas if you've got income being generated by, say, a family discretionary trust, there's a discretion as to who you distribute the money to. That being said, it's quite interesting when you actually start drilling through into the detail, because up here we've got the minor tax rates, and you can see that a minor can get the grand sum of $416 of income per year tax-free. So we're not really talking about big bickies here. They get hit with 68%, and once they go 1,307, they're taxed as if they're at the top tax bracket. So the effect of the 68% is to basically neutralise the nil on the $0 to $416, so that essentially if you're distributing more than $416 to a minor, go over $1,307, they're paying 47% tax on that income. There are exceptions, for example, testamentary trusts, which have got concessional tax rates because there's a recognition that if somebody dies and then distributes, they get concessionally taxed. So the minors out of those ones, on the other hand, are taxed as if they're adults. But I suppose the big one is down here, for example, and Paul mentioned it before, the wife who doesn't work. You can distribute some income to her. That's a bit of a concern. Interestingly, I suppose a lot of these sorts of things are targeted at people like myself in the large firms, where there are certain arrangements that you can enter into that can be quite beneficial. But interestingly, in order to do some of these things, you need to have an average tax rate of 30% on the income. And that is exactly where the Labor Party has come out. On the next slide, I sort of just demonstrate the timeline that the Labor Party, they're not in power, so obviously it's just an announcement. It'll be interesting to see if they can ever legislate it if they get elected. And with Section 44 of the Constitution, it might come earlier than we expect. So you can sort of see here, they're looking at a 1 July 2019 start date. They're expecting a huge amount of revenue to flow out of this. It'll be really quite interesting to see if these revenue numbers come to bear. It's certainly something that's quite easy to target because it's seen as being a tax on the rich. Negative gearing is something that gets a lot of airplay as well. So really simple example, you get $20,000 of costs. Invariably, a lot of those are not cash costs. So it'll be, for example, tax depreciation, and you get less rent. So you basically have a tax loss on the asset. This has already been attacked by the Liberal Party in the latest budget. So there's exposure draft legislation that has been released, and what that exposure draft legislation is sought to do, and the announcement of the government is that taxpayers who buy a second-hand property aren't entitled to tax depreciation in respect of the depreciable assets that are part of the property when you acquire it. The problem was you had the likes of various depreciation companies, and so basically the concern was there's multiple problems with it. That you had a dishwasher, say, in the kitchen. Obviously the person who put the dishwasher in gets their depreciation. Then a person buys a property, and then you get a surveyor to come in and say, oh, I think the cost of that dishwasher to you when you bought this property was a certain amount, and often it was quite similar to the original purchase price. And so we had multiple depreciations in respect of the same asset. And then at the end of the day, it's possible and probable that people would forget that they had part of their purchase price allocated to these depreciable assets for which they got depreciation for. And so what it meant was that they basically got it in their cost base, and so there's basically a double benefit. That was non-compliance. It's not a strategy, it's probably evasion, but it's probably, it might not be, evasion's a very strong word, but it's certainly not correct. And so that's sort of where this sort of came in terms of negative gearing. So we've already seen some part of the attacks. I've got some headlines here around the fact that a lot of people think it's the rich who are getting all of the negative gearing benefits, but actually a lot of normal average wage earners obtain benefits out of negative gearing. You saw before there's a huge government expenditure in relation to super funds. This is a response to that in the last budget. So we've probably heard about the $1.6 million ceiling in relation to what you can have in super funds. So the idea was that the government thought the $1.6 million was an adequate amount for somebody to have in retirement in the concessionally taxed environment. It's quite interesting as to some of the strategies that came out at the end of last year in relation to this proposal, because you had up until 30 June this year to do some restructuring. But the net effect of it is intended to be that you get the concessional 0% tax rate, particularly in pension paying phase, at 0%. Everything else is taxed as if it's accumulation at 15%. So that's the intention of the measure. Interestingly, there are different strategies that people already got to employ in relation to that. Paul's talked about the cash economy. There's actually a big review in relation to the black economy. It's actually by Michael Andrews. He's sort of chairing it at the moment. He used to be the chair of the Board of Tax. It's moving in relation to the cash economy. We've heard certain proposals talked about, not necessarily through Michael Andrews, but the government in relation to whether they want to have $100 notes, for example, because it facilitates the cash economy. Whether we need to have real-time reporting. And last week there was an announcement by the government in relation to payments for employers with 20 or more employees, that they're actually now going to be required from 1 July next year to, in real time, report to the tax office any payments they make to their staff, any super fund payments they make for their staff. So this is a real thing that needs to be done by employers, and 20 employees and more, that's not a big enterprise. And a lot of our clients have already told us that they think that this is all going to be done by their software provider. And from what we can understand, that's not necessarily going to be the case. It's going to be a very big cost in relation to an IT system upgrade. But the Black Economy Task Force is charged with trying to capture that revenue, because the ATO has been successful in attacking a lot of the big multinationals. I'm in the face of it myself. I have to do a lot of tax disputes with the tax office. And thankfully, most of my clients, we are within the bounds of the law. And what we say to the tax office sometimes is, if you have a problem with the result and we've applied the law, then maybe the law has to change. But you shouldn't be blaming us for applying the law in the way that we do, because we're just applying. That's the role of the law of the land. So the black economy is trying to capture some of this revenue that's being foregone. Next slide, if it comes. What's going on there? There we go. So these are some of the things the Black Economy Task Force are currently looking at. This is quite an interesting proposal that's come out as part of the sort of recommendations. One of them is to develop a proposal whereby if you actually aren't regarded as a good taxpayer, the government will not contract with you. And so you can't actually get a contract with the federal government. And there's various other ones in here that are quite interesting, and they're all wages to be paid electronically and reported in real time. These are the sorts of things that are quite interesting in relation to how much revenue they'll generate. But at the end of the day, the big data they'll get from this, and the tax office has a lot of big data, and they're getting very good at actually analysing the data that's coming through.
Matt, how many other countries have something similar to this?
I don't think any country's got something similar to this. What I'm going to do now is just take you through, because the whole idea of the talk is about the great tax RORT. So I thought I'd just take you through a few structures and a few ideas as to what people have implemented over time. And as you'll see, these things have been struck down by the ATO and ultimately struck down by the courts. This is a very big case. This is actually one of the biggest transfer pricing cases in Australian history. I understand that the legal fees in relation to this matter run into the tens of millions. And it's been running, and it's only the 18th of August this month that Chevron finally gave up and withdrew their appeal to the High Court. So what is Chevron? It's actually quite a simple idea. So what it is Chevron's a US incorporated company, had an Australian subsidiary, and they're doing a significant amount of good in terms of the investment in this country. And then they established a US subsidiary. So what did they do? They borrowed money from their parent, and then they invested it in shares in this company in the US, and then they borrowed the money back. And so you're sitting there, and I guess not being tax professionals thinking, well, what's the play here? What's the go? What are you doing? So they borrowed 2.5 billion at between 1 and 2% in the US. They then on-lent at around 9%. But in some, actually have these rules called CFC rules, Control Foreign Company rules. And what these rules are intended to do is to actually attribute that income back in sort of a situation like this. But because it's in the US is regarded as a comparable taxed jurisdiction to Australia, so there's no attribution back to Australia. So that's the first point. From a US tax perspective, they could actually do what they call check the box on this Australian entity. So basically they ignored Australia. So it's basically income being received by this subsidiary being paid by the parent for US tax purposes. So it's sort of a nothing. And the big point was that the dividends that get paid by this company back to Australia, because of an exemption in our Tax Act, are exempt from tax. So the effect was, and obviously Chevron Australia paid interest on the loan back to the US and got a tax deduction in Australia. So in effect, it was free tax deduction in Australia. And this got litigated for quite some time. So tens of millions of dollars were spent on this case. And I don't want to go into the intricacies of all of the discussion. There's arguments that the case was never actually run in terms of a proper case where one person put an argument and the other person responded. There's all sorts of different views that have been expressed in relation to this case. But you can sort of see this is the sort of thing the tax office really did not like. And they attacked it on transfer pricing grounds. But equally, they could have gone on, we've got a very strong general anti-avoidance rule. And so maybe they could have got that. So that's just an example in relation to what they were doing. So what's the tax office's response to this? So they've now put out, they call it a PCG, a practical companion guide to the law. They've actually put out this table. It's hard to read. I'm not intending that you read all of this. It's actually in an ATO document. Basically, it's a flagging exercise. They're looking at things like how much of a margin are you charging? So this is a response to Chevron. So they're looking at a lot of corporate groups coming into Australia and also going out of Australia to see whether they're trying to erode the tax base in Australia. So this is what they're doing. It's only currently there in terms of one part of there's only one schedule that's been released. There's going to be more schedules released shortly, but that's the intention, and the tax office is all over this. And I'm sure they'll be a lot more confident now that they've actually had the Chevron matter withdrawn, and that's now final law, full federal court. Orica is a similar case. I thought I had a diagram, but I didn't actually find it's not there. So you can go to the next slide if you'd like, and I can sort of work it out off this slide. So effectively, like this is, I'll talk about this shortly, but what Orica did is effectively is tax consolidated group basically had a loan within the tax consolidated group, borrowed money, invested in shares in the offshore company, borrowed it back. So it's very similar to Chevron, and that was struck down. So again, you know, the tax office picked up on it, said, no, this is wrong. The taxpayer in that case was arguing, you know, what we're trying to do is actually not get an Australian tax benefit. They actually had the subsidiary, not in Australia, like shown here, but in the United States. And in the United States, as Paul has said, tax rates of about 40%. Australia got a tax rate of 30%. It's what we'd call a reverse arbitrage. We're actually paying more tax in the other jurisdiction. But the reason they were wanting to do that, this is the argument from the taxpayer, was they had tax losses in the US. And in order to actually have those tax losses recognised in the US, they wanted to be de-recognised for accounting purposes, because I was saying, well, we don't actually know whether you're ever going to utilise these losses in the US. And so the idea was to actually generate income in the US to recognise those tax losses because they had an impact on their financial statements. That was the argument being put by the taxpayer, but ultimately that was not accepted. This is yep. Yep. Yeah, both of them. Both. Yeah. So related party cross-currency interest rate swaps is quite interesting, because I've never advised a client to do this, and the tax office has been right across this probably for 20 years. And every time I got into a tax dispute with a banking client where there are swaps involved, one of the first questions I'd be asked is this a financing arrangement? Is it a hidden financing arrangement? The reason I'd ask that is because when you actually pay a swap payment out of Australia, it's not regarded as something that's subject to withholding tax. And so you could potentially get out of withholding tax free in relation to a swap payment. And so it's very hard to actually price a swap. And so the tax office is always suspicious about it. So that's what the tax office started getting concerned about in relation to this, whether this is a disguised financing arrangement coming through the swap payments. Procurement hubs is something that's become very topical. It's probably one of the areas that sort of started a lot of the big debate around whether large multinational corporates are rorting the system. It's quite a simple, to be frank, if you look at it on the page, and it's much more complicated than this in real life. But basically what occurs is Australian multinational sets up a procurement hub, so sets up a company, say in Singapore. The Singaporean company buys, say, iron ore off that Australian multinational before it gets to China, say. And the procurement hub, which has marketing services and all sorts of other obligations, receives a very large markup in order to on-sell that iron ore to China. So that's sort of the idea of the procurement hub.
And the benefit to the taxpayer under that arrangement is?
So obviously they're suppressing the amount of income in Australia. The argument is that it's active income in, say, Singapore, and so you don't end up with any tax on that income. And then this, for the same reasons as we talked about in terms of Chevron, when the dividend comes back from the procurement hub back to the Australian multinational, it's tax-free. And so you can actually defer tax in effect. And that's a really important point in terms of taxation. If a company saves corporate tax, in Australia we've got a dividend imputation system. So they don't get franking credits when they get this income coming back, non-assessable, non-exempt. When they pay it to an Australian domestic shareholder, that ultimately should be unfranked income. And so the individual will end up paying their marginal tax rate. And so it's sort of a deferment exercise. And it's something that Paul and I disagree on a little bit, which is in relation to whether there should be a difference between the individual and the corporate tax rate. I hear what Paul says, and a lot of other people say it as well, that having the difference, the arbitrage between the individual tax rate and the corporate tax rate can encourage people to try and move income into a company. But we've got a lot of rules within our Tax Act that actually try to prevent you from doing that, particularly around Division 7A and some of the provisions prior to that. So there are provisions there that try and prevent that. And from a purist point of view, you've got a dividend imputation system. Companies employ people. They've shown that a significant amount of income tax that's saved gets passed on through increased wages and more investment. And so it actually improves the economy. And people have a propensity to spend, and so there's a multiplier effect through the economy. That's the argument in relation to having a lower corporate tax rate, and that's where we're sort of going to with the 25% tax. Stable structures is very topical at the moment. I've been in a lot of consultations in relation to these structures. So Paul talked about the recharacterisation of income, and this is in essence what the concern is with stapled structures. So what a staple, I'm not sure whether people are fully aware of what a staple structure is. I deal with them all the time, so I'll just quickly explain it. So in essence, this is what we'd call a rental staple, and this is a typical structure for a listed property trust. So a listed property trust, say, would buy their assets in a trust for tax purposes, tax flow through. So the investors pay the tax on the net profit, the net income of that trust. But we've got very, very narrow rules in relation to what that asset trust can do. And so people started getting concerned a number of years ago, saying, well, there's other things that we do, for example, a concierge. The income from concierge is not good income for these purposes, and it could actually, what we'd say, blow up that asset trust for that flow-through purpose. And as a consequence of that, people started establishing companies on the side to actually capture that so-called bad income, so you wouldn't blow up the tax flow-through treatment on that side. And it's another important point to realise that a lot of these things is being done for really good commercial reasons. For example, with an asset trust, if you don't have the tax leakage out of that asset trust, you can actually borrow more money from the bank. And capital, if you're looking at debt capital, it's generally cheaper than equity capital. And so you actually drop the cost of your capital, so you're actually making more return out of that asset trust. So that's one of the really important purposes for having that coming out of the asset trust. With the OpCo, obviously it needs to have some access to the land. So what occurs is it leases part of the land, say, and then pays some rent back. That rent is good income. And so what the tax office started getting concerned with, people started getting a bit more exotic with this particular type of structure. So rather than being a listed property trust, people started putting other types of businesses into these structures. And they've come up with things like, they call it a royalty staple, there's a finance staple. Finance staple is probably the easiest one to explain. So what the finance staple is when you're putting your capital into these two sides of the structure, you put most of your capital into the asset trust. The asset trust then makes a loan across to this operating company. This operating company could carry on a normal business, so it derives income, gets a deduction for the interest going across to the asset trust. That interest is also concessionally taxed. And so that was the concern. So the tax officer's concern is there's a recharacterisation of this operating income through the use of this mechanism to actually get it out, particularly interest, because interest can actually flow off to a non-resident investor at a 10% tax rate. So people started getting concerned about that. The tax officers recognised there are good staples, and like property one's probably a good staple. There's quite a lot of good staples around, but that is the sort of concern the tax office has expressed. Okay. I might run a bit over time, slightly. I'm quite passionate about tax, so I like it. So this is something that's been brought into our general anti-avoidance rules. It's a multinational anti-avoidance law. This is actually an example of where somebody's tried to get around the law. I'll explain what the rules are and then explain what this is intended to do. So in essence, what occurs is you have an Australian entity that has, well, a foreign entity that has an Australian subsidiary, say. And what occurs under the multinational anti-avoidance law, the whole purpose of it was, where it started to get developed, it was sort of probably a bit earlier in terms of some of the technology that people had, but it's coming around, a lot of it because of the internet business. So when people actually have your foreign entity that enters into a contract with an Australian and then gets a fee back into a low tax jurisdiction, say Singapore again. So the revenue is booked in Singapore, but in order to actually make that sale in Australia, you can't just be doing it off the internet. Often you'll have a company in Australia that actually services your customers. And so what they're saying, this is an avoidance of a PE, because if that Singaporean company actually had people in Australia and was servicing those customers, there would be a permanent establishment in Australia. And the rules say that if there's a permanent establishment in Australia, a foreigner is going to be taxed on Australian sourced income. And so they'll be taxed in Australia on that income, but because of this mechanism, they'll normally use a cost plus approach. They'll have a few employees in Australia, they'll get reimbursed for their salary and wages, for the rent, etc., get a small margin, they only pay tax on the small margin, leave most of the revenue offshore in the tax haven. So that's where this was sort of born, this anti-avoidance law. So basically, if there's a principal purpose now of the avoidance in relation to that sort of arrangement, there will be a deemed permanent establishment of that foreign enterprise in Australia, and they'll have to pay tax in Australia. So the ATO sort of got onto it, so did Treasury. We've got a law that's already active. Diverted profits tax is a new one. It's sort of similar, but you've got a lot of lines here, but I'll simplify it. So, for example, what you'll often have is the foreign company, head company will have a low tax jurisdiction. They'll also have another company in like a tax haven. So what will often happen is they will, again, book the income back into a low tax jurisdiction. They'll pay a royalty, often off to another jurisdiction to, again, go possibly to a 0% tax rate. You'll keep the income offshore, particularly, say, a US company, because if they bring the profits home, they'll have to pay tax back at 40%. And basically, you're not getting enough tax in Australia. And so we've brought in a diverted profits tax. And it's actually quite penal. It's a 40% tax. And I don't want to go into it in too much detail because I don't have time. But it's a very penal tax. And in order to actually even dispute it, you need to basically have to pay it up front. And then basically it's 18 months before you can actually get it back, even if you win. Common reporting standards. Under the BEPS initiatives and different initiatives, different revenue authorities are now talking to each other and exchanging information automatically under our tax treaties so that they can actually see what's going on around the world. Because one of the problems before, a lot of the tax structured stuff that I've done early in my career was, there was a lot of tax differences between jurisdictions. There's not a lot of flow of information between jurisdictions, whereas now we have the technology to do that. So we can actually capture the information and actually share it between the revenue authorities around the world so they can get a world picture in relation to a particular taxpayer. Country by country reporting is another example of that. So country by country reporting, there's going to be a master file at the head office level as well as local files further down. And there's certain information that's going to be disclosed to the tax office so they can actually get an understanding as to what your country by country tax is like, in essence. We spoke about this earlier. This is the enterprise tax plan. So this is the reduction of the corporate tax rate. This is the announcement. You can sort of see here, these are the ones that have been announced. So you've got $50 million of revenue. So we're sort of here at 2017-18. So they've brought the amount up to 25 million, the revenue turnover. You get the 27.5% tax rate down to 25% by 26-27. This is what I spoke about before in relation to failure to lodge. You can see the penalties for 1 day late, $105,000 if you're a significant global enterprise. It's a massive number, particularly when you regard it's any tax obligation of an SGE. If they miss by 1 day, $105,000, and can go up to $525,000 for each document. So it's a big stick, and it's an example where basically there's a bidding war between the parties as to who could be more penal on people. Increased penalties, we've spoken about that, so probably don't have to talk about that anymore. Finally, before we go to our possible solutions, this is actually another graph out of one of the Treasury documents. And it's a very interesting one because what it shows is the excess marginal burden in relation to particular taxes. So what it's saying is, if I collect $1 of revenue under a particular tax, what is the burden to actually collect that tax? And so you can sort of see stamp duties on conveyances, probably the most inefficient tax to have. We're talking about probably around 75 cents in the dollar is spent to collect $1 of revenue. On the other end of the spectrum, you've got municipal rates and land taxes. And interestingly, it's actually got a negative burden. And the negative burden is because you don't have to, it's actually quite hard to, I suppose, to manage around. It's quite difficult to say that you don't own that land. The land's there, it's easy to tax. You own it, you pay the tax. Then you've got the GST. And this is certainly something that's being discussed very heavily in relation to the GST. I know it's really difficult politically, but you can sort of see, even as compared to an income tax, a corporate income tax is probably about 50% of the money's sort of gone in terms of people paying advisors, paying the tax office. It's also the inefficiencies within the economy and the flow-on effects within the economy of having those sorts of taxes in place. And so you can sort of see 50% versus the GST, which is down to around 20%. So you can actually collect the same amount of revenue, but have significantly bigger benefits for the economy. And this is sort of the debate, but it's a very difficult debate to have politically, because we're sort of saying, like, I can express the Deloitte view in terms of the public view, and the public view in relation to GST is that we felt that the rate should be raised to possibly 15% rather than 10% and get rid of most of the exemptions, because it makes a very simple tax. It's just a 15% rate. We don't have to worry about all of these different exemptions and reducing tax credits and all different things within the GST legislation. Make it simple, have a flat rate, have just on pretty much everything, and then you have a much better, more efficient taxation system, and we can actually get that additional revenue and pass it back in individual tax rates being reduced. So I'll pass over to Paul in terms of possible solutions.
Okay, so to wrap it up, we've pointed out a number of areas where more taxes could be raised and some areas where taxes are leaking out. Okay, capital gains tax. Now, this is an incredibly difficult political one to make a change to, because the people in this room and people our age, and the people that own the assets, are basically saying, no, get your grubby little mitts off of my house. And this is by far and away the simplest and most fair way to make a big difference. But unfortunately, through political pressure, it's unlikely to happen in the short term.
Yeah, one more point on the CGT discount. It's quite interesting that when the 50% discount was incorporated and Costello brought it in, it was on the basis of certain assumptions around inflation in particular. And we've been in a very low inflation environment for a long time. And if you we've actually remodeled it, and if you actually use the inflation rates as applied to us for the last X number of years since 1999, that rate should not be 50%. Because the idea was that it wasn't meant to give a huge benefit to everybody. The idea was that it was sort of to be quite similar to the old indexation system that people might be familiar with. And so the idea is that the 50% maybe should have been 33 1/3% if you actually get the same modelled outcomes that Costello was looking for when he actually introduced the discount capital gains tax.
Matt's already spoken about GST, land tax he's spoken about as well. Those are two things that could make a simple difference for us. Minimize arbitrage opportunities, we've talked about that. Like Matt said, we don't necessarily agree on that one. But not only arbitrage opportunities for different tax rates for different entities, but arbitrage opportunities across countries. Now that's a much more difficult thing to do because you need international treaties and it takes a long time to work out. Simplifying rules. We have one of the nation's leading tax experts here. Matt, do you understand the Australian tax law?
I tell my clients I do.
Okay, I'll leave it there. But the point is that
this is being recorded.
We have a set of laws that are so complex that even highly educated, highly intelligent people who spend 12 to 16 hours a day working on this stuff can't really understand everything there is to understand about it. And the reason that most of those complexities come in is that people build in exceptions for themselves, and politicians cave in. And anytime we see complexity, basically it means somebody's getting done over. The simpler the tax system is, the less that most people get done over. And finally, there's some international treaties, and we won't go into the details of this, but Australia has been and is currently one of the world leaders in treaties for taxation across boundaries. We need to continue that. We need to continue to lead that. And it's in our own national interests. Since the day that the white guys turned up in this country, Australia has been an importer of capital. If we don't import capital into Australia, every single person in our country will have a worse standard of living. So we need to do things that make Australia an attractive place to invest. However, in doing that, we can't afford to get into bidding rates with other jurisdictions as to who's got the lowest tax rates. So we need to enter into intelligent international treaties that mean that Australia remains an attractive place to invest, and at the same time, we still collect sufficient tax to enable us to have this kind of society that we want to have. Thank you.